Welcome, everyone. Thank you for joining us for this month's State of Freight. My name is Emily Cash with the FreightWaves media team, and I'll be your host for today. I'm happy to be joined by Craig Fuller, CEO, founder at FreightWaves, and Zach Strickland, head of Freight Market Intelligence at Sonar. Today's conversation will cover the latest from Sonar, current market trends, and analysis from our experts. Craig and Zach will also be answering your questions following the discussion, so make sure to have your questions for them. Before we get started, I'd like to cover just a couple of housekeeping items. First, if you have any issues during the webinar, please feel free to reach out to me via the chat section in your webinar console. And as I just mentioned, we're also going to have a live audience Q&A following the discussion. You can enter those questions in your Q&A box in your webinar console. And again, we'll try to get to as many as we can. We'll also be sending a recording of this webinar live to you via the email you used to register with. So you're welcome to use that to share with your colleagues or watch on demand. And at this point, I'll go ahead and turn it over to Craig for an exciting new announcement. Craig?
Yeah, so I'm excited to announce that we have launched the Trade War Command Center inside of Sonar. Trade War Command Center is a dashboard that takes in all of the data points that you would care about if you are interested in what's going on real time as it relates to the trade war. So this is export activity out of China, export activity out of all of the other major countries around the world. It's import activity to the ports. It's really a dashboard that brings it all together in a single example of what's happening on the ground so that you're not having to go dig through information inside of Sonar. Again, what I love about this is it is a fantastic way to understand the data that's happening right inside the platform. So every Sonar subscriber gets the Trade War Command Center, and so it is a default option inside of Sonar.
Yeah, I mean, this is pretty exciting for me too, because it allows you to, inside of Sonar, you have to generally kind of go around and know where you're navigating to get some of these tickers and values. We're kind of consolidating all of that. And it's not just about the ocean data, but it's also a connective tissue, if you will, to some of the surface transportation environment. At the top of the Trade War dashboard, you have ocean volume, intermodal volume, and
why don't we
truckload
pull
volume.
this up? Because I think this is a really interesting way for our folks to actually get a live perspective. Let's zoom in on this, because I think there's a really important sort of things that you can see is ocean volume. So if you look at it, Zach, and this is version 1, by the way.
Yeah.
We've already got version 2 and 3. I was sitting back with the team about an hour ago, talking what we want for some of the additional data. Really excited about this. Maybe the most exciting dashboard that we've launched in a long time. So ocean volume showing week over week, month over month. This is ocean container volume specifically using our IOTI index. That's in the upper left-hand corner. Intermodal volume does show the domestic and loaded volumes. There's a slight update on that where you'll actually see the numbers. I don't know why that wasn't in there. Truckload volume will show week over week, month over month, and year over year change in terms of markets. LMI, you want to talk a little bit about the LMI, one of your favorite indices?
Yeah, so this is basically, we picked out a few of the components of the LMI, which is the Logistics Managers Index. And it's, you're looking at inventory levels, because this is, of course, what helps dictate whether or not you need to bring freight into the country. How full are those inventory levels getting? Warehouse capacity. We've had so many questions about warehousing over the last several months because of the pull forward activity. And then we have warehousing prices. And of course, warehousing prices they tend to always be inflationary. They are inflationary beyond what you would normally expect. Anything, by the way, fun fact about the LMI, anything above a 70 is pretty much a statistical anomaly. It is a very strong expansion.
It's on fire.
Yeah.
If you own warehouses, it's on fire.
Yeah, so
you've done really well with that. The thing is, the LMI is a survey like the ISM. It's a diffusion index. Anything above 50 is expansionary. 400 supply chain and logistics professionals are interviewed every single month by 4 universities have done this. This is public data, but we are presenting it right here in Sonar. Next is our top gateways snapshot. This is actually a table. You could take multiple data sets. So right here is top gateways, what's into the United States in terms of volume. You're seeing that data, looking at week over week, month over month, year over year. I think it's really important because as you think things are changing, this is what is being cleared customs. There's also, if you, in the upper right-hand corner, you can flip this out to look at countries of origin and origin volumes by country. Destinations we're showing right here, which is just where is the freight headed. We also have country origins as well.
Yeah, you can look at the IOTI either by origin country or destination port, which I think is very interesting because the way I typically view this data is I want to know, okay, where's it coming from? How long do we have before this freight, starts to make an influence on the domestic transportation environment? You typically have about a 15 to 20 day window now coming from Asia to the port.
Can we pull up in the back? Can we pull up the top origins dashboard? Because I think it's interesting to sort of see how countries, their volumes are changing.
Yeah, because and the bookings data is giving you that upstream look. So bookings, the way that this is organized is based on time of departure from the port of lading. And as you know, it takes a different amount of time to get from China to the West Coast and the East Coast. And of course, the other countries have their own transit times, especially from Europe. So looking at that on a more of a lane level basis helps you kind of identify when can we expect some of this freight to start manifesting either in the West Coast or the East Coast. And this has been a huge trend to monitor over the last month and a half to 2 months as we've seen this pull forward effect really hit the coasts at different points in time. So bookings and then customs data is also in there that we don't have showing right now. But the custom data tells you basically when is it ready to be transported. So we're telling you when is it leaving the ports.
Or when's it cleared, customs.
And then when does it clear customs?
And you're saying transported domestic.
Domestic,
to the domestic
yes.
market. Just to be very clear what that means is. Now, one of the things I think is interesting is actually customs, the bonded warehouse stuff actually does impact when stuff is cleared. So sometimes the customs data, as bonded warehouses become more important, the customs data actually is not showing all the volume, which is one of the weird, confusing elements here.
And customs data itself is pretty volatile.
It's very lagged, too. The bookings data is far better. The nice thing is you're being able to show this. I love this dashboard. Next, we have the IOTI charts down below, which is just be able to see year-over-year activity. You can see, I mean, what I think is really interesting is look at that shaded blue, which is current year 2025. You can see the collapse really from, early April to where we're at today. One of the things to keep in mind is this is on a 14-day lag.
Yep.
So we are coming out with a new instance, hopefully in the next day or so. We're also having a war on data and trying to get better intelligence on the ground. When the market's not moving as fast as it is, daily data just doesn't matter. And it's somewhat, if you're looking at daily data, it's really confusing because you're trying to draw conclusions. But we are coming out with we have the data daily. The data science team is working on getting that published. Hopefully in the next couple of days, this whole trade war command center will continue to have more and more features to it. And then last up is the daily spot or the weekly spot prices. I guess you have the daily spot prices for containers. The daily doesn't move that much on international container on these big trade lanes. But it is, I think, really important.
I expect that it will here in the coming weeks.
But it is a reflection of what's happening. You do see some incremental moves. But just look at where we've been from March. That's all, look at how stable ocean container prices have been. Credit to the ocean container lines for exploiting their market position by pulling capacity off the market.
And if you pull this chart all the way back out over the 5 years, we're still not at where we were pre-COVID.
I know. It's interesting because the ocean container lines are truly maintaining pricing power. And you can see that they are pulling, there was an article that came out this past week about it came out by CNN. It was a really poorly written headline. And it got a lot of heat on X, which was there were no ships headed to LA, which was actually incorrect.
Right.
But what was actually happening is the ocean container lines had canceled so many voyages that there was a gap in the transit times. And so in those cancellations, which you're showing right here, is as many as 20% of cancellations. By the way, just since we're thinking about the Trade War Command Center, can we put this on the Trade War Command Center, the rejections?
We can do whatever you want to do.
I want to add that to it because that's cool. That is really interesting data for people to understand the percent of voyages that are being canceled.
Yeah, can they? There we go. We have to put it up on the screen.
I'm looking at the wrong screen.
I've showed this before on State of Freight where we see, but we've never really seen this. And you can see the rejection rates, which is really a reflection of blank sailings and kind of movement of shipping lane activity really spikes at the end of April. And this, of course, is due to the fact that there was a lower expectation for the amount of freight moving from China. So they had to manage some of that capacity. In LTL, it makes more sense to me because you don't want to cut a truck that's half full. And that's effectively what they're doing.
You don't want it to go out. Right?
Yeah, you don't want to move that truck because you end up losing money on the truck. And that's effectively what they were trying to do here. I think it's interesting to see how quickly this
Well, I
changes.
think one of the things that's happened, if you look at the Port of LA tracker, and so I got asked this, and at first it looked really confusing because you saw this pretty significant drawdown in freight demand, and then you saw this 1 week, which would be next week, not this week, but next week, this pretty substantial rebound. And this is before the trade war pause,
Right.
or the accelerated tariff pause. I think what's really interesting about this is that the increase in volume, when you look at it in terms of what's happening this week, it looks like there was this sort of massive, like somebody asked me, is the trade war over? And it's like, no, what the ocean container lines were doing were just consolidating their freight, holding their freight. So waiting to fill up those voyages, and they got enough to build the voyages, and they all kind of went out at once.
Yeah, I think, looking at the trade war dashboard here, and some of the things that we've been talking about over the last year in terms of intermodal really taking over a lot of the share, which is, the truckload market definitely suffering from their actually speed of service to an extent. A lot of the shipping companies are saying like, hey, let's just keep it on intermodal. And that's why we have intermodal included here in case people are wondering, is we're trying to connect the supply chain together with this dashboard to let you know, like maybe you don't understand or care about what's going on over the ocean, but you probably do care about what's happening domestically. And this, personally, I didn't look at intermodal at all when I was back in the trucking days to understand how the dynamics were happening. With the trade war and all the pull forward stuff, we can clearly see that we have not had demand fall over the last year, not to the extent that the overt truckload volumes would suggest in the OTVI.
Yeah, I think to your point, intermodal has sort of been this backdrop that if you're in real-time trucking, you don't think about. But I think in this environment, particularly talking international freight, it is far more important.
Yeah, because it's the easiest way to just say, I'm going to pull that container right off a boat and put it onto the rails because I have an extended lead time. Something that we've been monitoring was the shift in overall volume. So I'm going to pull up the chart of OTVI and O-Rail here, which is the loaded container volumes. And you can see that we have started to see some net deterioration in surface transportation. We've got a 0% year over year on the O-Rail today and a negative 9%. Now, this is a daily index, so there's a little bit of volatility, but it does look like we were seeing kind of the front edge of some deterioration in volumes.
Yeah, I mean, I think certainly intermodal has exposure to international container. And as those container volumes have dropped, it's certainly showing up in the intermodal data.
Yeah.
And then when we look at OTVI, we saw, so there was intermodal has been really expansionary for a while.
This is the first time we've kind of seen this flattening. And of course, you can see here in that the most recent couple of days, the most recent prints, this is where we're seeing the front edge of that container drop, as they're hitting the West Coast. Like we're not seeing, they were expecting, I think Gene Soroka pointed out a 35% drop in container volumes going to the ports of Los Angeles and Long Beach. And I think we're starting to see that manifest on the loaded container side.
Yeah, I think you're right. And I think it's going to be interesting to watch what happens. We have this bounce back that's happening that, the trade war has been paused. And in that pause, it's going to be interesting to see how fast things bounce back. I mean, there was some data this morning. FreightWaves covered the headline. I think it's gotten somewhat confused in terms of what was happening. So 255 Vision, which is a small data provider that tracks international ocean bookings, came out and talked about the fact there was a 255% increase in ocean container volumes. What they actually were saying was since Sunday, there's been a 255% increase, which does actually track.
Right.
And I think it's an important data point. And it does suggest that there is a pretty substantial rebound. but it's not saying that there's a 255% increase than even 2 weeks ago or a month ago,
Right.
or certainly not over year. So it's important to understand that that 255% is directionally high volume, but it's not something that anyone should think that we're going to see 300 or 400% sustained.
Right, and we're certainly not
I
seeing.
retweeted this and didn't add that context to it. But we are seeing a rebound. Hapag-Lloyd, the Wall Street Journal reported that Hapag-Lloyd said that their bookings were up as much as 50%. I think that does suggest that we are seeing a really nice rebound in the market.
Yeah, I mean, if we pull up the charts here on Sonar, the way we display it in our Sonar is more of a smooth 7-day moving average. This is more of a raw print that you're looking at here. And of course, we compared it to Vision's data and his LinkedIn post here. They're telling the same story. Effectively, we put our moving average on it because you see this, how erratic it is. In a normal period of time, this is a hard thing to read and understand unless you have a moving average. It's only in times of transition like we're seeing today where you really want to see this daily value. And what Ben was pointing out here is that he took, a low point in the data series and compared it to a high point in the data series. And it was off-centered by, he was comparing Sunday data to Tuesday data, which is also going to be kind of a intermittent seasonal low. But it's, percentages can get a little wonky.
It does. The headline of 255 is a really interesting one because it does show that there's been a bounce back, a sharp bounce back.
And a sharp one in the last
really,
2 days.
I mean, and frankly, above any level. But I think it's very clear what you sort of have to understand the context there.
Yeah.
Not 255, 277, I think.
277, yeah.
But it's still important to know that this is after a pretty substantial lull.
Yeah.
What it does reinforce is that there was a lot of pent-up demand that has been
I'm curious to see
caused.
how far this goes.
I think we should talk about that because I think you do have the short-term bounce back, which is definitely happening. And I think we'll have this happen for a period of time, right?
Yep.
This is going to be something that isn't short-term. Is it going to be short-term? We're going to have it for at least for a week or 2 weeks as people deal with volumes, probably longer, a month, because we've lost volumes for over a month. And then you had all the paused orders.
Yeah.
One of the things, I don't remember which, was it Bloomberg or Reuters or the Journal, that said that a lot of factories in China are running at capacity because they've had a flood of orders.
Well, they got to turn back on.
in.
It's basically like a Lunar New Year.
Well, it's like I would even compare it, Zach.
And they just had May Day too. So.
I would compare it more to what we saw during COVID, where we saw this pretty substantial, basically shutting off the economy,
Right.
and then turning it all back on.
Right.
And so this bounce back, and I think also companies say, I have 90 days. I don't know what's going to happen beyond that. And so the flood of orders and the concentration of orders is just so tight. I think it's going to be a pretty substantial rebound. And I think it will show up in trucking data pretty soon.
What do you think about, Gene Soroka came out and said that he does not expect a wave of imports to flood.
I saw that. Look, there's a lot of fog of war. I saw the quote.
Yeah.
I did not read the context. And sometimes people have taken what I've said out of context.
Sure.
And oftentimes. So it's hard to know what he was referring to. And again, I haven't read the specific article. I think it was the Journal that had quoted him.
Right.
So I can't speak about that. I'll say, as we all have at times, we've misinterpreted things.
Right.
There's a lot of fog of war that's happening. While I have an enormous amount of respect for Gene and his, ability to understand what's happening, I also have, if you remember back in the summer of 22, he also didn't understand there was a collapse in Chinese volume. So the data he may be looking at is what's coming inbound.
Yeah, I mean, it was like
and not
day
what's
one.
happening on the ground.
Yeah.
And so one of the things, and you can go back and look in summer of 22 when we looked at the import collapse, that was showing up in our data, but it wasn't showing up in any of the other data. In fact, and so he was saying there wasn't a collapse when there clearly was, but it may just be that the data sets that he's using are looking at what's headed to the port and not what's there. And so you get this sort of, we all do it. We all have our own data sets. And sometimes with this fog of war situation, things are happening so aggressively and so violently that perhaps you're not seeing these things happen the way that you would expect them to.
Yeah, I want to pull up the IOTI on the big chart here. It's, of course, in the trade war dashboard, but I want to take a little deeper look because I'm comparing this to a Lunar New Year. And if you're not familiar with the IOTI, it's bookings of 20-foot equivalent units on a 14-day moving average coming into the United States. So you see that big dip every year in February. That is the Lunar New Year period where production effectively shuts down for a couple of weeks in China. You look at the current dip there, we're pretty darn close to a Lunar New Year-esque style dip. Now, I think the big question is, seeing as most companies and businesses are not accustomed to having a Lunar New Year in May, does this manifest into we see it in a sense last year. We had container volumes, if you look at the teal line there, that's last year. We saw this ramping in peak season. So peak season for maritime is July, August-ish. I think the big question is, do we see kind of a strong, because now we're going to have restock.
I think you're going to have I think 22 is 22 is your best example of this. Is like, I think you're going to have a pretty strong and violent snapback. I think it's going to be an aggressive V-shape. It is going to look a lot like this is a Lunar New Year kind of rebound, but even more so. Remember, what's happening right now, if you sort of take the executive order at face value, you have a 90-day pause. It is very clear that there's a lot of uncertainty. And it is clear that there is the potential of it going either way. So I think but the risk is, so people say, well, what if it goes down? What if it goes down? But the risk is actually on the other side, what if it goes up?
Right.
I mean, you're at 30% tariffs right now.
Still higher than April 1st, correct?
Well, it's the April 2nd
or
date
April
that
2nd,
matters, which was 54% tariffs on China. We're at 30% now, so they've actually pulled back. This is like one of the arguments that people have been making in international trade is like, Trump came out and said, anyone retaliates, I'm going to go crazy, I'm really going to double retaliate against them. He did, but now China tariffs into the United States from China are actually lower than they were on Liberation Day. So it's kind of this irony of like, the Chinese, did they play their cards correctly or not? And who knows? But what I'll say is, I think most importers can survive a 30% tariff.
Right.
I think very few companies are going to be in a position not to import this because they're not going to like it. It's going to be painful. But I think most companies have that expectation built into their margins. And so that 30% tariff that is going to be paid is going to be something that people say, I can go ahead and afford this because the worst thing for me is that this goes way high and hyperbolic like we saw, or it ends up I can't get my hands on inventory. So I think that's really what is going to be the risk. And so I think companies are going to be prioritizing their trade flows over the next couple of weeks. And I think that's why we will see a very aggressive rebound.
Yeah, and we've actually seen, while we were paused and basically took a break.
I think this plays out of the course of a couple of even months being 1 to 2, because we have a 90-day timeline. Because if these orders are flowing in, I can't remember who reported it, but if all this capacity is sold out, then you're going to have a backlog of orders. And the Chinese manufacturers don't want to be caught off guard like they were last time.
Right.
So they're going to be trying to produce these products as fast as possible to get them on the ocean. So we're going to see a pretty violent surge of demand.
I mean, and so talk to the surface transportation providers for a minute here. And, this takes, I mentioned 15 to 20 days. We've seen actually the service deteriorate on the Trans-Pacific over the last bit. Some of that may come back as they kind of ramp capacity back up. But how does that translate to domestic freight volume and freight?
Well, the stuff's all got to come in, right?
Yeah.
And so you think about the fact that if you go back to COVID where we had the bottleneck, we don't have bottlenecks right now.
Right.
But a couple of things have been happening. One is the container vessel companies have been cutting capacity. So the ships that would normally be in a normal transit flow have been cut. And so it takes a little bit of time. The container boxes that haven't been coming over so you have all this sort of restarting has created its own challenges.
Right.
But we weren't shut down long enough to have this problem. That seems to me to be a much smaller problem to deal with than the bigger issue, which is the surge of orders. What's going to happen is freight's going to flow in. Companies are taking possession of that inventory, and a large percent of that inventory is probably, some of this will be replenishment of inventories that were going to be stocked out.
Yep.
But a good portion of it, and perhaps the majority of it, will be freight that's actually not needed for months or quarters ahead. So you could see a lot of holiday goods. Companies may have been shipping in September and not even early October, before Golden Week. They're going to push those orders into June. And so we're going to see an enormous amount of freight flow into warehouses and distribution centers, which is, if you go back to our trade dashboard, Zach, real quick, because I think this is really important, pull up this right here on warehouse prices and warehouse capacity. Warehouse prices are already reflecting conditions that, I mean, look at 11% month over month change. I think when we go look at this data in the next month, when the next release is out, I expect that to have increased.
Right.
And I expect warehouse capacity to, by the way, it's declining, right?
It actually, so warehouse capacity expanded, which means they're getting more warehousing room.
Yeah, but that should lower. Should we see a decrease
I think
in that?
in the next month, we actually should see that deteriorate potentially. It just depends on the timing.
The number would deteriorate because capacity starts to shrink.
Yeah, it should shrink a little bit potentially because we had this the last glut. Now, I say that's really talking about April, because the pull forward ended in April.
But companies know, if you run a warehouse operation, you know, that's why warehouse prices are reflecting this.
Yeah.
But I also think capacity will probably decrease as freight comes in.
So freight for the next month will not be coming in. So therefore, we actually should see an increase in this value. Yeah.
Fair.
I had to think that through in my head.
You're right. But what I'm saying is, like, so much of this cargo is going to flow into warehouses. And what's going to happen there is that it's going to be sitting there for a couple of months. So I don't know how much demand we will see short term in the domestic freight market. I think a lot of intermodal should bounce back pretty quickly, because these are, again, moving warehouses. We've seen over the last year that companies were taking advantage of intermodal's price delta, the cheaper freight, but also the warehouse on wheels concept, the warehouse on rails concept. And so I think what we'll see is that intermodal will come back pretty violently. I think when we move into the sort of late summer, back to school, late summer, that's when a lot of those products are going to be moving.
I'm bullish on both modes, intermodal and trucking.
When do you think we see
mid to late summer?
When do you think we see a violent bounce back in volume in trucking?
I feel like our summer, this is lining up for a pretty bullish moment summer peak.
So the freight, can we actually call the freight recession dead this time? I mean, it got resurrected.
I mean, we can't control
it's resurrected
economics,
for 3 months. The 3 months resurrection, not 3 days.
But I mean, if you think about it, you've got, okay, they start ordering the last couple of days, whatever percentage you want to call it, 50 to 75% based on some of our estimates. That's not going to land for another 30-ish days. And then it's going to, start moving. And then you're going to get this stronger kind of wave coming in. You're talking about mid to late June. If you kind of do the math on the transit times, I mean, I guess I'm talking about the bookings, which take about a 7 to 8 day lead before they actually depart for the United States. So yeah, it'll be about mid to late June before the first wave of goods really lands.
Yeah.
By that period of time, you've got inventory levels, which most companies keep about a month and a third to a month and a half of inventory.
They have been, and some of the bigger companies have had as much as 2 to 3 months because of pre-planning forward tariffs.
So you're going to land with this, return to pull forward and a restock simultaneous in July-ish.
Yeah.
And then you got back to school, like you mentioned.
Yeah, but back to school should be, at the end of the day, so June and July.
Yeah.
So in your estimation, July is about the time frame when you would expect things, which is usually a relatively soft month. It's not a great month.
It's a
sluggish month because sort of late summer, people are not consuming product; they're consuming, travel. July is usually a pretty weak month.
Anytime you transition from an end quarter to a first of a quarter,
absolutely, it's a softer month. But July is typically a soft month. But I think when we move into August and September.
Yeah.
So that's when we could see this violent pretty violent snapback. Now the question is, and I'd like to think what you say on this is, do you think that we see an acceleration in tariffs, or do you think that this is where we're at?
You're asking me to predict something that has been unpredictable for the last bit. I think the signal in my mind is kind of a softer approach for the moment, that it's not going to change. I think we're stuck in this realm of tariffs. Like as long as
Well, look, I think tariffs are in, like, even
they're gonna
Biden
be
didn't
there.
reverse tariffs. I don't think there's any appetite. We are done with globalization as we once knew it. There's
Yeah,
definitely. So let's accept that. And you and I agree. And I think the administration has said we will never see tariffs below 10%. Let's just accept that to be the fact. But I think the question is the China tariff specifically, because that's all that matters.
Yeah.
Like, let's just be honest. Like, yes, other countries matter. Tariffs will be impactful, and we are going to have a situation where, in about 60 days, the tariffs that were implemented, it's even less than that, I think we're 50 days at this point, that were implemented on all the other countries, not China, are going to be, they're going to come up with they're going to be due.
Yeah.
And so if countries haven't negotiated some framework, then there's a possibility that there is some acceleration of those tariffs. It's going to be interesting to watch. That will give us the first sense for how the administration may handle China. I personally believe that we're unlikely to see a reduction beyond below 30%.
Oh yeah, with China for sure.
I think the administration is very comfortable with 30%, and
I'm
I
shocked
think
that it went that
importers. I think they knew they had to do something because they were getting a lot of pressure, and they have other things that they want to accomplish. And if you look at, like, when Trump first took office, it felt like every single day, but certainly a few times a week, we were getting tariff conversation. If you look at the last, really, it's been the last, 3 weeks?
Been very slow.
There's been very Trump, except when asked.
Yeah.
But we haven't gotten a lot of tweets and conversation about new tariff policy, new changes. He will respond to a press question about it, but he seems to have moved on to other things. You've got the new bill, you've got what's happened in the Middle East, you've got some really interesting deals that are done in the Middle East. To me, and it looks like Bassett, the Treasury Secretary, is the one leading the charge on tariffs.
Yeah, he feels like he's handed that over to him.
And so it feels like we've moved beyond some of the chaos into something that's more rational. So where I sit is I think the 30% doesn't go lower, but I can't imagine it goes much higher.
Yeah, I feel like I agree with you almost in total. I feel like we're in a softer approach environment.
Which is actually a really good thing. Now,
100%.
I think, frankly, from a freight standpoint, if you're a shipper, you probably feel different in this conversation. But if you're a transportation provider, a 30% tariff with some uncertainty is actually bullish for freight markets from both a volume standpoint and a pricing standpoint, because the uncertainty will force importers to bring in freight longer
and
take more buffer stock with the uncertainty, because they don't know when it ends. 30% is not punitive to the point where it destroys demand. I don't think. I think most businesses can handle 30%. Again, don't like it. There is a slowdown in capital spending and investment, but it is something that they can absorb. It does not slow volumes to the degree where you had this
doesn't shut down production.
Embargo.
Yeah.
And it is expensive enough that it does nudge companies to say, I need to explore alternatives.
Right.
Now, we did get an interesting tweet. I don't know if you saw this, but Trump did tweet about his that he was upset at Apple building phones in India.
Yeah.
Which was a trade-related thing. But I think that's just, who knows? That may have just been a late night.
He likes to tweet. I try not to put a lot of stuff.
So having said that, I think we could see the second half of this year could be pretty interesting.
So let's talk about the freight market. Let's talk about the truckload space here, because I've been sitting on my outbound tender rejection chart here for a second, and it's road check week, Craig.
It's a good week. I have heard from channel checks that capacity is tight.
Yep.
It is hard for brokers to find capacity.
Yep.
And I think that's great news. And let's talk about how soft. Can we pull up volume for a minute? Because I think we need a backdrop of this for a second.
Come on.
Trucking volumes have been
find
pretty freaking anemic over the last couple of weeks, right? Really, since February, since Valentine's Day.
Where's my OTVI?
OTVI volumes have been down. And let's pull this chart up real quick. So when you look at the volumes from Valentine's Day, we are well below 2023 levels, and you can see that volumes have been pretty anemic. Easter is that big
trough,
dip, and Easter always moves, so it's always hard to remember where.
Yeah, you can see it last year in the same shape almost.
But I think what's really interesting, Zach, is that the trucking volume across the domestic market has been pretty sluggish for the last 2 quarters.
It's slow but stable. I mean, outside
Here's
of February.
why I think this should be encouraging to anybody that's actually listening to us, is soft volumes. Volumes have been pretty, I wouldn't say, maybe, recessed is the right term, but
Well, we're below 2023, which
I know,
is not
it's
a
been
great.
pretty, and you can see in the public earnings of public companies, it's been pretty bad. Some of these companies, I mean, I don't know if you saw PAM, 111 OR, and Werner had 105, I think, OR.
Yeah, the utilization is way down.
Heartland had a negative OR. I mean, it's been one of the worst earnings quarters. But what I think is interesting is volumes are really weak. But then let's go to rejections. Because I think the interesting dichotomy here is volumes are weak, but rejections have actually stayed
up
5.5%. And so it is interesting how well the market has performed in terms of rejections. It's at a respectful level in spite of really sluggish volumes.
Yeah, I agree with that.
And I think what's interesting about this is that if we do, and I believe that we have certainly made the case that there will be a violent a snapback in freight volumes, in spite of what the economy does. I want to make that very clear. The economy itself can be in a very challenged spot. We could actually be in a true multi-quarter recession that goes on for a while, maybe 6-9 months. But the freight market do well. And the reason being is that the freight market is responding to trade manipulation, trade impacts, trade absorption issues that have nothing to do with the broader economy that will insulate the freight market from some of the other economic challenges. And as long as there is that surge of uncertainty in trade, it will create more freight demand. And so we could see, and I believe we will, a pretty strong recovery in the second half of the year. Probably starting, as you have pointed out, as early as June.
Yeah, June, July.
But as it recovers, that rejection rate at 5.5% means that we could be onto something pretty cool.
Well, you keep talking about calling the freight recession's end back in November.
I know, I'm gonna get so much hate.
And I have defended this statement because this chart right here, the rejection index that you're looking at, it's stayed elevated year over year over year.
It is, look, if you looked at it in a year over year basis, the thesis that I made back in November, as you can see in green, is that the freight market was responding to normal conditions. And as you look at this, it was in recovery. It was very clear that the trucking market was in recovery headed into this year.
And
the trade uncertainty started really around Valentine's Day is when things started to fall apart.
And I think to the transportation service providers out there that are like, well, I'm not recovered yet. Well, it's because a 5% rejection rate is still weak. It's still weak. It's
but
not.
It hasn't gone to 2.5%. It hasn't. And so, if we get a violent snapback again, I think we will. I think we will see the rejection rate climb pretty significantly.
I was at a conference recently, and I was making the statement basically saying, well, the freight recession is supposed to be over. Why is it still challenging still? I was like, listen, if you look at the rejection rate index, and the analogy I used was, it's like when your kid runs away from you, or it runs away from its mom, and it's about to jump off a cliff into the water. Mom puts her hand out and said, no. That's what this feels like to me, is that kind of with all this tariff and trade policy uncertainty, we were on the precipice, of
a great recovery.
Of a pretty strong move in this market. And I think the volatility that you see here in this white line in March, that's a little bit of tariff uncertainty stuff with some cross-border trade issues manifesting there, but it's not all that way. I've got some charts here, and I don't think.
But I want to talk a little bit about. So you talk about road check.
Oh yeah, we didn't even get to road check
because that road check is happening this week
right now.
Getting channel checked. We are hearing it's not showing it yet in the data, and this is a 7-day.
It's on its way.
You want to talk about it?
Yeah. Oh my God, yes. So last year, you see the teal greenish line there. Road check week happens, and then we get this huge bump. We have not seen that type of bump from road check since before COVID. This year we are on the last, so that's reflecting the second day of road check in the white line right now, and you can see how strong of an upturn that is. I think this thing, and again, this is a 7-day moving average. And of course, road check week, for those of you not familiar, is when there's a huge amount of, there's a blitz of safety inspection. We had another layer of the English language requirement that is now also a part of this. And what happens is a lot of the drivers, especially owner operators, just take the week off, especially in a down cycle type environment where rates don't really support you taking the chance of driving and getting pulled over and shut down.
Nobody wants to deal with the hassle
No.
and getting put out of service, which is really the risk. Because if you put out of service, you go out of service for a period of time, and then you have to basically deal with whatever issue exists and prove that you've done it. So they don't want to be put out of service, and they don't want it showing up because it does impact their insurance rates. It does show up if there's ever a court case against them, the liability showing out of service incidents, because it's all recorded.
Yep.
Even shippers, if you have a lot of out of service incidents, will not give you freight because they consider you an at-risk carrier. So a lot of drivers and owner operators specifically just don't deal with the hassles, and nobody wants to be dealing with the hassles. When there's hall monitors out in the roads, you won't deal with it. One of the interesting things that you just mentioned that I think has to be discussed is this executive order that came out where it ordered the Department of Transportation to basically create compliance rules around these rules that already existed, but enforcement of those rules, which is the English speaking requirement and ensuring that a driver has a CDL that has passed the CDL certifications under US standards. And what is interesting about this is this is obviously a polarizing concept, because I understand the context of it, and it feels very targeted for some folks, but it also feels, if you actually look at the data, the number of people that we've issued driver's license to that did not pass a CDL test, that do not live in the United States, Mexico, or Canada, because we have reciprocity in those three countries under NAFTA. There are tens of thousands of CDLs that have been issued to drivers that never went through a US CDL test. And there's been a lot of great reporting, frankly, not by FreightWaves, by some of our competitors. Overdrive Magazine did a fantastic article about this. We have covered it, to be clear, but I actually think Overdrive deserves a lot of credit because they did the hard work of going FOIA request to actually go to the States to find out these driver's license.
Deal about the government bureaucracy steps.
Yeah, they did it. So they deserve an enormous amount of credit because credit where credit's due. They did the work.
Yep.
And what they determined is that this is absolutely happening. Tom Albrecht sent me something yesterday, which was a breakdown of, I don't know if you had this. I
didn't put it in here, but
it's the CDLs issued, the percent of CDLs issued to non-U.S. residents.
Right.
To basically, in some cases, we're up 400, 500. I think Puerto Rico had, 1,800% or something like that? It was insane. And so this is absolutely happening. They're issuing CDLs to people who should not qualify for CDLs. We've seen a rash of really fatal accidents. There was one here in Chattanooga that killed a family of three.
Two of them,
There's another one that happened in sort of central Tennessee, Mount Juliet, that also, and these are foreign drivers. 40% of drivers, according to a friend of mine that runs an insurance company, are issued to first generation immigrants. Many of them are legally able to work here. But what's interesting about it is under the Obama administration basically told the states not to enforce immigration laws, but they could not put a driver out of service who did not have proper work permits. That's the insane part, is like the driver
can't enforce the law.
They can't enforce immigration because this is a federal issue, not a state issue. That has obviously been overturned by Trump, and that's what this enforcement is about. So you now have a backdrop for a capacity crunch, because if the number is 40%, and if 10% of those folks can't speak, or 10% of the total trucking population can't speak English, even if 20%, 2 or 3% get pulled out of service, then we could see a size. It feels very small, but this market, as we have made the case, pull up rejection rates here, guys. We have made the case that it is in balance. It is ready to go. You get a combination of volume and a capacity crunch.
Yeah.
It could be off to the races.
Yeah, I mean, we're right on the border of it. And it feels that way. All it needs is some of this demand to kind of like tip the scales on the other side. And of course, if we have a big 2 to 3% reduction in overall capacity on top of what we've already seen, I mean, this has been 3 years of reductions in capacity. If you look at all the major carriers.
And I do think, once you lose the driver population, once you actually churn through drivers, that is when you will see a capacity crunch. And really this whole non-resident driver issue, domicile driver is what they call it, has been going on since 2019. That's when a lot of this has been happening. So I think we're about to see a pretty interesting freight market.
I want to pull up one last chart before we get to tie this all together. Okay, we talked about Road Check Week, we talked about the trade war. This is why rejections are high right now. So this is a chart of tender rejection rates for Savannah, Georgia, in white, 16, 17%. And then there's Los Angeles at 2.2%. There has been an enormous amount of focus on West Coast freight and volume, and we talked about intermodal taking a lot of that share from the West Coast. Carrier networks are so far out of balance, and that's what's happening as capacity's fallen down. We're now seeing, and we can see import waves coming into Savannah as well, still from the pull forward effect in April, creating this disproportionate amount of coverage, or an East Coast versus West Coast. I looked at the spot rate chart this week. Almost all of the increases are East Coast centric, which is the area where we typically see most of the driver population. So to me, this is why, like, if we get another wave coming into the ports, it's,
you could see rates go up significantly.
Exactly.
You could see a short squeeze, as they like to say.
Yeah. All right, well, I'll hand it over to Emily there, and let's get going with some Q&A.
Excellent. All right. So yes, as Zach said, we're going to go ahead and dive into Q&A. So again, if you want to ask questions, you can just enter those in our Q&A box. All right. So with that, let's go ahead and dive in. We've got lots of good questions. Let's start with this one. What's one misconception about the current freight market that you think needs to be cleared up today?
One misconception? I think it's one of the things that people have commented on is the change. And so people who aren't paying attention to freight are like, how do we go from inventory stock out risks and a pretty sharp slowdown in freight 1 week talking about a pretty significant slowdown, the next week being bullish? How does this bipolar level of uncertainty, of indecision, of contradictions happen? Context matters. The world, we're in a fog of war situation. But this is even fog of war. When the circumstances on the ground have changed, this is going to change. The slowdown in freight that we have seen since mid-February, the freight recovery that stopped, as you described it, has all been trade related and policy related. But now what we've seen is a pretty sharp, imagine if we had started the Trump administration with 145% tariffs. Let's imagine that had gone on for many, many years, and all of a sudden we got a new trade policy and we reduced it to 30%. There would be no one disputing the fact that there would be a massive surge. And so what we saw 2 weeks ago was a pretty significant slowdown due to this shock of 145%, where we went from, low tariffs to really high tariffs. And now we've seen a snap back where things are being significantly reduced. This is the bullwhip effect in real time.
Yeah, I think, we talked about this a little bit with the misconception that the freight market is, still in this depressed environment, when actually it's just not recovered enough, is the thing that I would call it. And this, as you're talking about these uncertainties, really manifesting, uncertainties stagnate us, and then when you get some sort of messaging or clarification, they create these these very volatile moments. And that's the thing that's going to eventually it's going to manifest in a way that's going to be very confusing to a lot of people because people are generally confused.
So there's a pricing analyst that is on X, and he likes to argue with me. He works at a very large logistics operator, and he likes to counterpoint. He said something I think is correct. Now I've made counterpoints, but his point is the time when you see a massive acceleration in the market, a change of the guard, if you will, is there has to be a catalyst. And he brought up, hurricanes, weather events. When you see a significant macro level event that shocks the freight market is when you do see a change of the guard. We were certainly in recovery. It didn't feel that way for so many people. But if you want to see this market go into a completely different realm of reality, you need a macro shock. And that's what we're getting with this trade policy change.
Yeah, I agree with that.
Pause.
Let's go.
Excellent. All right, let's move on to this next question. It is a little long, so please bear with me. Are you seeing the Texas-Mexico border region experiencing a surge in industrial growth? Is it beneficial for the major Texas metro areas like Houston and Dallas, Fort Worth? Anything you see on the trucking volume perspective from Laredo to Dallas?
Yeah, I mean, this has been something that's been building. We even talked about it years ago, is that if you look at market share gains in freight, even when the freight recession was sort of at its peak and was really, really challenged, there were 3 markets in the US that actually had growth. One was Detroit, that was auto. A lot of this, the Build Back Better plan under Biden was driving some of the auto, the EV, sort of electrification of autos. The second was Houston, and a lot of that was petrochemical. Sort of the Port of Houston was growing some market share, but also Laredo. That was another market that saw massive, couple 100% relative gains of volume over the last couple of years, where it was years ago.
Yeah, it wasn't that long ago. Now the automotive industry is kind of on a pause, if you will. They've had their own kind of
You can see it in PAM, PTSI's public traded.
Yeah, and again, that's the cross-border trade with Mexico is very heavily, influenced by the automotive sector. So we haven't seen nearly the amount of activity. Like if you looked at the rejection index in March, actually a lot of that was derivative of the Canadian border crossing activity kind of moving around. That's also somewhat automotive centric. And since then, we haven't really seen it open up again. And I think that's because we're still having so much uncertainty around, that policy there. If it's not under the USMCA agreement, like what does it mean? We still got steel and other things or components, some that come from China that have actually stalled some of the industrial manufacturing. As I was talking to Dr. Zach Rogers a few weeks ago, he said that a lot of the upstream manufacturers who are supposed to be benefiting from the tariffs in the long run are actually suffering in the near term because they can't get, a lot of the tariff exemptions are occurring on finished goods and not on components. And that's actually slowing, especially in the North American corridors, some of this.
If
this
Trump
sector.
moves out of trade war, a trade war stance, which I at least that's what it appears that in recent weeks we've sort of shifted from a real hard trade war stance to a softening of that. Then I think manufacturing investment, the question was specifically about Texas.
Yeah.
I think we will see a lot more industrial plant. I think it was it Kraft Heinz announced they're going to spend $2 billion on a plant. We're going to get these big announcements because I think companies are they have to permanently shift production. For the last 3 months, all we've talked about is tariffs.
Right.
But we have forgotten that there are going to be, and before the trade war sort of kicked off in January, we were getting a lot of announcements of investment in the U.S. I don't know if you saw Qatar, 1.2 trillion. Those numbers have been questioned about whether they can pull it off and what the timeline is. Saudi Arabia announced a big level of investment, even in a U.S. refinery. So we could see substantial investments, which would frankly favor Texas because it's It has a lot of reasons to be favored.
It's got a ton of real estate. It's on the
Well,
border.
it's got an enormous amount of resources, energy prices, labor.
Energy
There's so
prices
many
are
reasons to
low.
love Texas. God bless Texas.
It's also perfectly positioned in supply chain.
It's the
domestically.
location.
Yeah.
Is great. And so I think, and look, USMCA has always been a question under this Trump administration on whether they love it or hate it.
Yeah.
I actually think that, again, as long as we don't see a reacceleration, who knows? I think that we will get a more stable environment. We haven't even talked about tax policy.
No.
This new bill is actually pretty substantial in
Yeah.
terms of some of the tax incentive. Bonus depreciation is going to create capital investment. That is back.
That's what happened in
100%.
2016 or 2017.
100% of bonus depreciation. You have no tax on tips, no tax on overtime. That is going to impact people who live, the marginal folks that tend to drive a lot of consumption,
Right.
typically younger, are going to end up having more cash to go spend. That is going to be stimulative. That's why the bond market is falling, or the 10
whole
years
nother
is
thing.
up. So anyways, that to me is also a thing that could drive the second half of the year. And inflation has been tamed. And I mean, I think everyone's questioning what happens, but we haven't seen the tariffs actually drive high inflation. If anything, energy prices are super low.
They're not going to yet.
Food prices
If they were.
actually,
And they'll probably be very
farmers-
specific. Yeah.
farmers have actually now have a glut of agricultural
Food's
products.
gone down.
Food's gone down and energy's gone down. Housing's going down. So in some ways,
These are not great things, though. But at the same time,
energy
it's-
being one of those actually is
Really helps a lot.
largely because we cooled the global economy. Now that could all heat up with this pause.
Exactly.
Who knows?
It's a very complex system.
Awesome. All right, let's move on to the next question. So Craig and Zach, you kind of already touched base on this English language proficiency law, but we're getting a lot of buzz and questions in the chat and Q&A box. So I'm gonna ask this question and just give this an opportunity for y'all if you wanna reiterate or add anything extra to the conversation. So this question is, do you believe the English language proficiency law will be actively and effectively enforced?
I think it's up to each state. I think states that tend to be more conservative, and you have really sort of, we call it red leaning states versus blue leaning states, I think absolutely will probably enforce those rules. I think states where, because there'll just be a lot of political support to do so. I think in parts of the rest of the country, California, New York, those are going to be more challenged.
Yeah. I've actually questioned this. I don't know, and again, this is, I just don't know how clearly or effectively you can enforce language.
Because the DOT has talked about having basically a question and answer, a standard format question, a Q&A that they get to ask, and the person has to be proficient. It's subjective, no doubt. Like there's a lot of subjectivity to it. But they just have to put them out of service. Like, I think, to me, look, if you look at law enforcement, people that work, whether at way stations, DOT inspectors, law enforcement, they tend to lean conservative because, and they tend to, if you sort of listen to a lot of the conversation, even at MATS, there was a conversation with a California State Highway Patrol person was basically talking how about his hands were, he gave a talk with us, his hands were tied.
Yeah.
He said, this is a problem. I can't do anything about it. I'm not allowed to enforce it. So law enforcement tends to be conservative. I think there'll be more enforcement of this, frankly, much more effectively than probably the Drug and Alcohol Clearinghouse, because it will be much more obvious if somebody has a work permit than if they don't. Take the English thing aside. If the person doesn't have a visa to work, and doesn't have a CDL, had gone through the CDL test, that is an area, I think, where there is an enforcement. It's not going to be overnight, but it is going to happen. And I would say I would be bullish on capacity in that situation, or bullish on a.
I like the hard copy stuff. That does make a lot of sense to me, but I don't know about the language tests. I'm not sure how that works.
Yeah, interesting stuff. All right, guys. Well, that is all the time that we do have for today. So I'm going to go ahead and close us out. So as I mentioned before, we are at the top of the hour. So Craig and Zach, thank you so much for your insights and being with us this afternoon. It's always great to have you sharing your insights with our audience. I know they really appreciate it. And before we break, I just want to highlight a few of our new exciting in-person events. that we have coming up. We want to see you in Washington, D.C. in July for our Supply Chain AI Symposium, and again in October for our big F3 Future of Freight Festival here in Chattanooga, the heart of Freight Alley. To learn more about these exciting events and to get tickets, head over to live.freightwaves.com. And with that, I'm going to officially end things and thank y'all again for joining for this month's State of Freight webinar.